Chapter 2. Understanding Behavioral Trends. In this chapter of the book, Mr. Parag Parikh discusses about 1. The evidence on equity returns, 2. Sources of returns, 3. Hypothetical study, growth in earnings, 4. Making sense out of Sensex, 5. Key lessons, 6. Successful investing. 1. The evidence on equity returns. Mr. Parikh starts by suggesting that people often associate higher returns with higher risks, leading them to consider equity investments as inherently risky due to the price volatility. In contrast, fixed income securities are often seen as safe because their prices remain stable. However, investors often overlook the factor of inflation, which can significantly impact the risk associated with fixed income investments. Inflation erodes the real value of fixed returns earned from fixed income securities over time. 1.1. Equity as an inflation hedge. Mr. Parikh suggests that equities are a good hedge against inflation. He illustrates this point by comparing the returns on equities and a fixed income instrument, which is Public Provident Fund from 1979 to 2007. During this period, equities have returned 19.67% per annum, while the returns on PPF have been just over 10.4% per annum, demonstrating the potential of equities to outperform fixed income securities in inflation-prone economies like India. 1.2. Investor perception versus reality. Despite the potential of equities to generate wealth and act as an inflation hedge, many investors perceive equity investments as dangerous. Mr. Parikh acknowledges that this perception is driven by the wild fluctuations in stock prices and the negative examples of investors and corporations going bankrupt in equity investing. 1.3. Understanding investor behavior. Here Mr. Parikh suggests that the reason for the paradox of successful equity investments and poor investor return outcomes lies in understanding investor behavior and its impact on stock prices, which is discussed in detail in later part of the book. 1.4. Is equity investing really risky? Mr. Parikh says that it is the behavioral traits of the investor in particular and the crowd behavior of the markets in general which makes equity investing appear a risky proposition. Understanding the behavior of the stock markets is the most difficult because markets are made on the basis of varied opinions expressed by their participants. Mr. Parikh discusses whether the perceived riskiness of equities is due to the inconsistent performance of the companies behind the stocks, or is it more to do with irrational behavior of stock investors and market participants who are influenced by fear and greed, and that leads to wide swings in returns for investors. 2. Sources of returns. In this part, Mr. Parikh discusses the sources of equity returns and highlights that, unlike bonds with predictable returns primarily from interest income, equity returns depend on two key sources. A. Fundamental returns. These returns are derived from the earnings and dividends of the underlying enterprise during the holding period. Fundamental returns are associated with the financial performance of the company. B. Speculative returns. Speculative returns are linked to changes in the market's assessment of the current performance and expected future profitability. These assessments affect the price-to-earnings (PE) ratio, leading to either PE expansion or PE contraction of the total shareholder return. Mr. Parikh emphasizes that speculative returns are influenced by market sentiment, the presence of greed and fear among investors, and can change rapidly. This element of speculation is what makes markets volatile, unpredictable, and intriguing. 3. Hypothetical study, growth in earnings. How 20% growth in earnings can lead to a weird set of performances. To illustrate the element of speculative returns, Mr. Parikh takes a hypothetical company by the name ABC Limited which has earnings per share of 10 rupees and is quoting at a PE ratio of 20. Resulting in a stock price of 200 rupees. Fast forward 1 year and imagine that ABC Limited grew its earnings by 20%, thereby increasing the earnings per share of 10 rupees by 20% to 12 rupees. In essence, with the business growing at 20%, The variation in the type of result generated for ABC shareholders is depicted with three different scenarios. Scenario 1. Stable PE ratio. Since the PE ratio remains stable at 20 times, this scenario would result in the stock price rising to 240 rupees. In the absence of any speculative element, the total returns generated by the investor from ABC Limited in the stable PE scenario would be indicative of the fundamental aspect of the business alone and nothing else. Scenario 2. PE ratio expansion. Let us assume that the PE ratio expands to 25. This increase in high speculative interest, which is the increase in the PE ratio, could be due to various reasons such as a change in sentiments, expected better fortunes of the sector or the company, or optimistic outlook of investors. This would result in the stock price rising from 200 rupees to 300 rupees, a total return of 50%, earning per share of 12 rupees multiplied by PE ratio of 25, as shown on your screen. In this scenario, the presence of a speculative element, the PE ratio expansion, is significant, as the return from speculative pay expansion at 60 rupees out of 100 rupees is more than the returns of rupees 40 out of 100 rupees generated due to fundamental increase in earnings per share. Scenario 3. PE ratio contraction. In this scenario, let us assume that the PE ratio falls to 15 now. The decrease in speculative interest towards the stock could result when the sector loses favor or simply the market participants grow pessimistic about the future prospects of the business. This would result in the stock price falling to 180 rupees, as depicted in the picture on your screen. In spite of the exceptional fundamental return of 20% generated for shareholders, the negative speculative element impacted the earnings appraisal in such a way that the total return generated for the shareholders was negative 10%. 3.1 Equity returns and PE. Role of PE expansion and contraction in equity returns. Mr. Parikh says that the above hypothetical examples drive home the importance of the PE ratio's contraction or expansion to the quality of returns generated for the investors. Understanding this relationship between stock returns and PE ratios helps one to identify opportunities which not only offer reasonable prospects of growth on the fundamental aspect, but also where a positive reappraisal of the earnings in the form of expansion of PE ratios is possible. In essence, the price paid, and not just the prospects alone, should determine the quality of returns. Mispriced opportunities arise, and the wise investor considers such opportunities as a good value proposition, and this is how the returns multiply for a value investor due to irrational investor behavior. 4. Making sense out of Sensex. In this section, Mr. Parikh discusses the returns generated by the BSE Sensex for the last 16 years from 1991 to 2007. His objective here is to try and dissect the return performance of the Sensex into two components, fundamental and speculative, as explained earlier in the video. The same is visible on your screen right now. Mr. Parikh concludes and says that in the table shown on your screen, one can see that 1991 saw the liberalization of the Indian economy, which was greeted with enthusiasm by the stock markets, and we had the Harshad Mehta boom. There was no change in the fundamental returns of the companies, but the sentiment had changed, leading to widespread optimism. This is reflected in the above table when one sees that speculative return in 1992 was 31.1% as against a measly fundamental return of just 5.8%. However, from 1994 to 1996 the fundamental return started going up, but the speculative returns were highly negative, signifying irrational investor behavior and opportunities for value investors. Again, during the tech boom in 1999 to 2000, we notice a high level of speculative activity but a decrease in fundamental returns. However, this was only in the technology sector and lasted for just a couple of years. From 2003 onwards, the sentiment started improving as good corporate results started flowing in. The fundamental returns began improving and so did the speculative returns. The bullish conditions were back and investor interest in stocks started soaring. Along with this, the growth in GDP, increased foreign institutional investor interest, the commodities boom and a host of other positive news as well as reforms of the economy took the index up from 2,800 in 2003 to 21,000 in January 2008. The above study clearly depicts how investor behavior affects stock prices. If one understands this, one will be able to benefit by making rational investment decisions and at the same time benefit from others' irrationality.
At EA Capital, we put in a lot of effort to create these videos, so if you like our content, please support us by hitting the like button and subscribe and share our channel.
5. Key lessons. 5.1 What makes investing risky? Mr. Parikh highlights an important factor pertaining to equity investing, that the returns not only depend on the earnings of the corporations constituting the Sensex but also on the changes in the pay ratios and investor sentiment. 5.2 Acquisition price determines stock returns. The change in PE ratios over a period of time signifies the change in sentiments of the investors. These changes could be due to several factors, like the change in business environment, change in the fortunes of a company, changes in sectoral performance, macroeconomic factors, government deregulation, and overall optimism or pessimism. These factors can bring in great opportunities for an investor waiting for such behavioral mispricing. This is amply evident if we look at the stellar performance of companies from 1995 to 1997 and the returns on the Sensex. These 3 years presented immense opportunities as tremendous amount of pessimism prevailed in the markets. During this period, though the corporate earnings grew at CAGR of 33.6%, but the Sensex dropped by 6.8%. What explains this anomaly of 33.6% CAGR for earnings translating into negative 2.7% return for shareholders during this 3-year period from 1995 to 1997 is that during the year 1994, excessive optimism prevailed and investors were willing to pay high valuations, which are reflected in the high PE of 34.5. However, this high PE prohibited the fundamental performance from being translated into commensurate returns for the shareholders. Hence, it is the acquisition price that determines stock returns. 5.3 Mr. Market oscillates between greed and fear. Mr. Parikh discusses the analogy of Mr. Market made famous by Mr. Benjamin Graham. He stresses the fact that markets repeatedly sway between optimism and pessimism. Markets are made up of emotional people whose decisions are based upon the prevailing sentiments in the environment. At times they display greed, and at other times this greed is displaced by fear. Bouts of greed and fear make the stock prices volatile, and investors get trapped in such volatility to lose fortunes. During the period 2001 to 2002, the corporate earnings grew at 8.8% compound annual growth rate by the end of 2002, but the Sensex delivered a negative 14.9% return to the investors. Hence, corporate performance and shareholders' performance can be diagonally opposite. It is the behavioral traits of the investor in particular and the crowd behavior of the markets in general which makes equity investing appear a risky proposition. Being aware and keeping one's emotions under control and at the same time understanding others' behavioral anomalies enables a wise investor to identify bargains. 5.4 Your discipline. Mr. Parikh says that it is not the fundamental performance alone which determines investor returns, but also the price one pays for those set of fundamentals. Being disciplined in your investment approach is very important. You don't get opportunities every day, and one must be prepared and ready with the money when opportunities come. Mr. Parikh highlights that real discipline and courage is to be able to buy when you emotionally do not feel like buying, and sell when your heart says hold but the mind and the logic says sell. 6. Successful investing. Here Mr. Parikh discusses why successful investing is so difficult. The most difficult part is understanding the behavior of the stock markets, because markets are made on the basis of varied opinions expressed by their participants, and these opinions are subject to change with the changes in the sentiments of these emotional people. Take for instance the Black Monday in May 2004, when the markets lost around 700 points as the election results brought the Congress to power. There was nothing wrong with the performance of the companies whose stock prices crashed, but the sentiment changed. BJP going out of power was a big change, and normally we do not like changes. Hence, there was gloom all around and people started dumping stocks as though there was going to be no future. The market started crashing as each one wanted to get out faster than his neighbor. Mr. Parikh reiterates that the smart investors are emotionally strong and buy when the others are selling in panic at bargain prices. These smart investors end up making a huge fortune. But this seems easy only in hindsight. At that point of time, to go against the crowd is the most difficult but the most sensible thing to do. Going against the crowd is the way to earn high investment returns. 6.1 90% follow the physical way. Mr. Parikh says that investment success will elude you if you do what 90% of the people do. Follow the physically difficult path. They come to the office early and stay late. They choose work over the family. They read a large number of reports very rapidly. They carry all the newspapers with them so that they can read them whenever time permits them. Their talk revolves on finding the next best investment opportunity to make money. They love to have more and more information as it gives them a feeling of being well connected and better informed. They love to be in an information overload mode. They thrive on confusion. In every way they put tremendous amount of physical energy and effort to try to beat the market by outworking the competition. But they don't realize that since 90% of the investors are also doing the same thing, the chance of success this way is minuscule. Even the professional and qualified investors also come into this category. The physically difficult way is more about trying to time the markets, finding the direction of the markets and getting as much information as possible to make investment decisions. This clouds the mind and distorts thinking. Mr. Parikh says that good opportunities come once in a while and you spot them only when you are cool and thus have the time to think. 6.2 10% follow the emotional way. Mr. Parikh says that investment success comes from following the emotionally difficult path. Emotionally difficult is to not buy when your friend tells you about the next 10 bagger, or when your favorite TV channel gives the stock of the month, or when your broker calls you up and asks you to buy the next multi-bagger. Emotionally difficult is to not sell when they tell you that the market is going to crash and the stock prices will nosedive, or when the analysts on the TV show talk about selling, or when newspapers start reporting the setting of a bear phase and suggest you to liquidate your portfolio. During these times, one does not require any intellectual effort or any physical effort, but emotional fortitude. Mr. Parikh suggests to never get carried away by market sentiments, as they only help you to make blunders. Control your emotions, believe in yourself and the investment policy you have committed yourself to. As the popular saying goes, when others are greedy, be fearful, and when others are fearful, be greedy.
For a one-to-one discussion with a highly experienced and knowledgeable finance professional at EA Capital, who always keep your interests ahead of everything and work in a completely transparent manner, you can write to us at info@eacapital.in, and one of our team members will get in touch with you. Stay tuned for next chapter.